If you're looking to buy EVOFEM Biosciences stock, then please keep watching this video because we're going to look at the company's recent news, how the market's treating it, and what are the technicals telling us, and most importantly, what is the best trading approach. As the market is very volatile for the moment, we should always keep in mind of which positions we pick, as well as their individual pertinence, timing, and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. EVOFEM had a great run over the past few weeks, and back then my prediction was to buy the stock first and to leave the allocations for later retracements in case they do occur. We are now in the second or even third week since the day when the stock skyrocketed as a result of fundamental driven motives, and the market participants are both increasingly interested and at the same time very worried that such a rise could not last. We have begun to see some inflection in the stock price, as the stock went down a little bit compared to where it was the week before. Now, could this be something that's going to continue? I believe that it's always been a possibility, and that now it's only reflecting that hypothesis. So, obviously, no one can predict the future for sure, and those tendencies are always just merely an analysis of the past trying to predict the future. But nevertheless, I think that the stock would be going through another few weeks of corrections to lower grounds before regrouping for another bullish run. Now, let's take a look at the technicals. The trading volume of EVOFEM has recently been around 37 million shares versus an average volume of 88 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $14.93. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market if there is enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be a possibility for uptrend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume could be significantly higher than the average volume. The market cap of EVOFEM is currently around $32 million versus an enterprise value of $174 million. Simply put, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is often the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, meaning they're not items that we can see, touch, or use right now, but they're pledges for a better future, such as major contracts, intellectual properties, and brandings. For most startups, their valuations are based on those intangibles, especially if they were valued in more favorable market conditions, which might cause a huge difference between a market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below the book value, but that doesn't mean that the company itself is necessarily undervalued. It's also possible that it was overvalued in the first place and only deflating back ever since. As we compare the current price to the historical price fluctuations, the stock is 203% higher than the 1-month low, 231% higher than the 3-month low, and 231% higher than the 52-week low. On the options market, giving a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 221% compared to the historical volatility of 345%. The put-call volume ratio is currently 0.17, and it is normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 13,000 contracts a day versus the 30-day average of 19,000. In terms of open interest, the most recent volume of open interest has been 133,000 contracts versus a 30-day average of 141,000 contracts. The option contracts are tools allowing traders to hedge their risk, increasing their exposure with limited downside or as an additional revenue stream. They are derivative contracts based on the underlying security. They give traders the possibility to buy or sell the security at a predetermined strike price and helps limiting the potential downside. The put options allow selling at the strike price, usually for anticipated downturns, and the call options allow buying at the strike price, usually chosen for anticipated bullish run. In terms of shareholder structure, institutional shareholders own 56% of the outstanding shares, the biggest shareholders including Vanguard, Mirador, and BlackRock. Usually, it's better to see some institutional participation when holding a stock in the medium or the long term, because it does offer a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it'll deliver value, which is very important to consider for the investors. I personally believe that a minimum threshold should be around 25 to 30% of institutional ownership. There might be many exceptions to this rule, but there will always be great companies mostly held by retail traders. Let's also take a look at the short interest of the stock, which is the number of positions that will profit from falling stock price. The way it works is that short positions will borrow the shares from the broker, selling them in the market and buying them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 to 30%, there could be a potential for short squeeze, whereby traders will buy the stock up, force those short positions to redeem themselves to avoid further losses, acting essentially as a buy in the stock market's price action. This is what people refer to as a short squeeze, and it became popular in recent times with the stocks like GameStop and AMC being successfully short squeezed. The short interest is currently about 51% of the total float, with 40% of the transactions out from the dark pools. If the short interest is above 15% of the total volume and a significant portion of it coming out outside of the public exchanges, this could suggest that there are institutional positions shorting the stock, with a potential for a short squeeze. I would therefore recommend to keep a position in EVOFEM and to have most of the allocated amount for later purchases over the next 6 to 9 months. The maximum capital to commit is recommended to keep between 1 to 3% of your portfolio, and to split the allocation in batches of 10 to 20% at a time to benefit from further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.